Hello, everybody, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy. And using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way to exit your highly appreciated assets tax deferred so you can create, preserve, and grow your wealth. I'm your co-host, Pearson York, filling in for Brett Swarts. And each episode, I'm joined by some of the best wealth, business, real estate, and leadership individuals in the world to share ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. As always, we're streaming on the expert CREsecrets.com and the Capital Gains Tax Solutions YouTube channel. Please hit that like button, subscribe button. It helps this channel out more than you guys could ever know. It allows us to bring on awesome guests to provide just a ton of value to you guys. So if you're liking what you're hearing, please hit the like button, subscribe button, leave a comment down below. It really helps us out. So thank you so much. Our next guest is a guy who's been in the financial services world for a very long time. He's does a lot of fractional CFO work, financial services, CPA. I will let him tell his story, but please welcome Stewart Heath. Stewart, how you doing, man?
Doing great. Thank you so much for having me. Really appreciate it.
Yeah, absolutely. Well, thank you so much for coming on. We really appreciate your time. So go ahead and just give us a little bit of background. Where are you from? How, where'd you get to where you are today?
Yeah, I'm from the South, born in Alabama, grew up in Tennessee, just south of Nashville. Went back to Alabama for college, went to Auburn, graduated from there, went back to Nashville to practice as a CPA. I started my career with Pricewaterhouse, which merged and is now known as PricewaterhouseCoopers. And didn't like working for other people, so I started my own accounting firm in 1989 and did that for about 20 years or so. And all the while, I discovered in about year 2000, I really like this real estate thing, and started out buying duplexes and then bunches of duplexes, and then got into home building and development, and had a few hiccups in 2008, 2009, and took some jobs in industry. Became a CFO for a couple of different companies. In 2017, kind of launched back out on my own again, and with exclusively fractional CFO work. And then in 2020, we launched a private equity real estate arm where we're focusing commercial real estate investments in the Tennessee Valley.
Awesome. So from CPA to real estate to fractional CFO services to back into real estate, coming full circle. So real estate sounds like your main passion, but the other ones seem to kind of pay the bills when you kind of hit the hiccups in 08, 09.
Yep. As some people call it, it was sort of my W-2. But I'm actually doing less and less fractional CFO work now. I have a few clients that I really love working with, and so I don't see any reason to stop that. It's a passion of mine, but I have declined taking on new engagements here the last couple of years because this real estate thing is working so well.
Yeah, well, I mean, real estate, it's hard to beat. So, okay, so before we dive into a little bit more of some of the value content, what are one or two strengths that you possess, spiritual gifts that have led you to be successful?
I have been blessed with a quick analytical mind. I can, in a very short period of time, I can size up a property or an investment with a combination of a short financial statement and a drive-by of the property. And so I can size up a deal and decide fairly quickly whether or not that's something we want to pursue. It's not that it's necessarily worth what the client says it is or the seller says it is, but does it have the potential to be worth what you want it to be? I've always, even when I started with duplexes, I could do a quick drive-by. I'm able to retain the knowledge of what rents are in the area, what they should be, and quickly size up a potential prospect.
That's really interesting. So I want to dive into that a little bit. What are the one or two secrets to being able to do that?
I think my secret is passion. For starters,
Mm-hmm.
I love this stuff, and real estate is interesting to me because it is, at the end of the day, relatively simple. All real estate is a financial transaction to me. That doesn't mean that I don't like the tenants or the people, which I do. We manage all of our own properties, and we can go into that later. But so I enjoy the people side of the business. But at the end of the day, I'm a CPA. I am I'm boiling everything down to dollars and cents and revenue and expense. And so in real estate, amongst anything else, is really simple when it comes to the income statement, the P&L, if you would. You've got your two or three sources of income, and then you got basically four line items of expense, and then you get to your NOI, net operating income. So that's, for the most part, pretty easy to analyze in your head. You can't do that with a tech business. You can't do that when you're developing a new software, because it's just a much more complex situation. So so real estate's fairly easy to analyze on the fly. That doesn't mean we don't go back and drill down and do our due diligence, but it's easy to eliminate things that you don't want to look at.
So your drive-bys are in your quick analytics is for the quick no, not
Yes,
necessarily for the
absolutely.
quick yes. Gotcha.
Absolutely.
That's a
Yeah.
huge distinction, because a lot
Huge.
of a lot of people are like, oh, cool, like, especially now with I believe, like, with the internet, like, people just like this ability to like purchase properties all over the United States online, like, and just, I mean, I've gotten, without loving to admit this, like, I've gotten myself into situations where I'm just like, that was stupid. Like, I've never even seen the property, and like we bought it just based upon numbers we thought and a market we thought we knew, and we didn't, and just like stuff happens all the time. So
Yeah, we all make mistakes.
yeah, well, we learn, right? Like,
Yeah.
someone once told me education is expensive. It is.
Oh yeah, I've my tuition's probably in the millions. So.
Yeah, oh, sure. So that should make everyone feel better who's made mistakes.
Yeah.
But I think what's important there is the fact that you just kind of take action and you just do it, because you're never going to get off the ground if you don't.
Yeah. Yeah. We won't buy one that we've never seen, and that's one that I've learned the hard way.
Sure.
I mean, to a certain extent, you can't trust people,
Right.
and it's even not that it's been they were distrustworthy people. It's just that you just don't know if you're aligned or not. So
Yeah, absolutely. You've been in the game for a while. Development from duplexes to single family home development, it sounds like. Now you're in
yeah,
commercial.
yeah.
What asset classes are you focused on, given the market, economics, situations, all of
Yeah.
that good stuff?
So we primarily focus on a geographic area,
Okay.
and which is the Tennessee Valley, or what we like to call the 840-565 corridor. So
Okay.
that's I-840, which is a loop south of Nashville, down through northern Alabama, which is an interstate called 565. So anything in between those two interstate, it's a lot of secondary and tertiary markets, but all of this is being driven by the growth of Huntsville, Alabama, which is massive. USA Today named them the
Sure.
best city to live in. So asset classes in that area is what we're focusing on right now. Is office, suburban office.
Interesting.
So it can be office / retail, and self storage. We love self storage. Self storage is a great way to play the multifamily boom without the toilets,
Mm-hmm.
and without dealing with crazy people per se. Um, I'm not against multifamily, but at least in our target area, I believe has been crazy overpriced.
Sure.
And one of our deals, our focus is cash flowing deals.
Of course.
So our deal will cash flow with money back to the investors every quarter from day one. There might be some value add as well, but there's going to be some cash flow, and there'll be some way that we improve the property. So I'm actually looking at a couple of multifamily deals right now, trying to make sense if that's something that we want to do. But we're not anti-multifamily, but I'm not really into single family build to rent either.
Yeah. Okay. So you've kind of axed the single family development. You're into the self-storage space is such a good, yes, people store their crap and like,
I know.
they're never going to let it go. I don't get it. Like I've done it
know.
myself. Like I think we had a storage unit for like 2.5 years and I don't even know what's in it. It's like, why do I have this? Stuff I don't need, stuff I don't
You're my
want,
favorite
and I'm paying
customer.
for it. I know. That's the thing. And if you got to kick somebody out, it's real easy to kick out crap, you know?
It is. Yeah. There's a whole reality TV show about it.
Yep.
So we've never had to do the auction thing yet. And I'm really not interested in taking people's stuff.
Storage wars.
But we might have a situation next month because we just bought one of these facilities in December, and there's a bit of clean out. I'll say
Sure.
the developer who built it, he built a great product, but he didn't know anything about management, and so there's out of 125 units, there's 6 people that we're inviting to not renew.
Yeah, there you go. Okay, so self-storage, what's the strategy? You mentioned that you have investors. I'm assuming you syndicate a lot of these properties.
Yep.
Are you, you mentioned value add. So are you buying, holding, and flipping? Are you long-term holds? What's your strategy?
Well, primarily we're long-term hold.
Okay.
Right now, but even in every long-term hold, we do like to see if there's an upside. Bought an office building in Spring Hill, Tennessee, a year ago. You start talking to the tenants, and I need this, and next thing you know, you're rejiggering a bunch of space, and you're getting people to sign up for longer leases at the current market rate rather than when they signed up, 3-4 years ago. Because COVID actually did office, at least in the South, a big favor, because a lot of people were left the office and they ignored their lease renewals, and when they did renew, they went real short term. Well, short term rates are higher, period, and then it's sort of fueled. When 2 years later, when we're going to keep an office. Now they want a 5-year lease. Well, now the baseline for all the rents are higher than they were. I was leasing that building a year ago at $18 a foot, and in the last 60 days, I've renewed a couple of leases at $21.50 a foot for longer term leases, and so that's the office. So we like long-term holds, but we like to see a little bit of upside to answer your question. The self-storage we bought, it's got 5 additional acres. It was only a 2-year-old facility, so we're going to continue on building those. Matter of fact, we're doing the engineering work. So I guess that's technically a value add, but I mean, we bought it in December. We've already sent money back to our investors on that one. Ahead of pro forma. So.
Yeah, interesting. So, all right. So I'm trying to decide which way I want to go with this because I got two questions for you. The first one is, a lot of people are afraid of office right now.
Mm-hmm.
You're buying office, and as you kind of just alluded to, COVID did office a favor, basically giving you a new baseline for higher rents. So, what made you decide to zig when everyone's zagging in the office space?
That office building, for starters, belonged to a client of mine, a not-for-profit, who I'd been telling for 3 years had no business owning that building. They didn't have the reserves. They weren't managing it right. And I was their fractional CFO and actually fixed all of their problems and
Sure.
just ended up paying more money for the building. I'm still very happy with the deal we got. And so I managed this building for 3 years in Spring Hill, Tennessee. So back up, a lot of people are afraid of office. But you got to understand, in the South, we kind of pretended like there wasn't a pandemic from about 90 days after, the lockdown anyway. And so everything's just been wide open. And now I am not interested in anybody's central business district office towers or anything like that, although there are some being built in Nashville and they're all mixed use kind of stuff. The suburban office, which is quasi retail anyway. I mean, these are businesses that cannot go remote. They're doctors, they're dentists, they are mortgage companies, which by law must have a brick and mortar office, even if your employees are originating mortgages from home. They're insurance companies, like your State Farms, Allstates.
Gotcha.
And there's just a whole bunch of, use types that cannot in any way, shape, or form go remote, and they have to have a place. And those are not located in central business districts. They are located in neighborhood settings. They're not far from your Home Depot, your Target, and whatnot. So I will, and that actually got confirmed to me by a conference I went to last week, where actually retail is on the rise. Basic glass front retail is actually on the rise because people are, they're leaving city centers again and moving back out into the suburbs.
So the service-based office spaces. So your medical office, your doctors, your I don't want to say subways because I think those are straight retail, but those type of. Are you in like strip malls at all? Then no.
Nope.
Okay,
I'm looking at some right now. Down in the Huntsville area, we've made an offer on a group, and they're full, and their primary tenants are pet care and beauty shops and things like that.
Your daily needs.
Yeah.
Okay, so when you're underwriting these deals, you said you want a little bit of upside. Are you liquidating any of them?
Not right now.
Not right now.
No.
Is there a liquidation in the future? At least built in.
We always present to the investors a 5-year out, or at least a 5-year time frame before they get all their money back. Because and we've already seen some interest rates coming back down. So I expect in 3 years we'll refinance, get all the investors their money back, and we might even pay a little bit higher rate. But we like all the interest rates that we have in our portfolio right now. But to get the money back to them, and some of them will want an exit. But honestly, I hope our investors want to stay in with us for the long term, because I think recurring cash flow is the key to wealth. There's nothing wrong with buying and selling every 5 years, but if you've got great assets, why do you want to roll it over when you can continue to borrow and distribute tax-free?
Yeah, that's interesting. So the tax-free part. I mean, we are capital gains tax solutions, so
absolutely.
Let's talk about that. So, what is your strategy for eliminating capital gains if you would sell, or what are some of the major tax benefits that you're kind of, I guess, receiving from your assets right now?
Yeah. Well, the entire investor class, of which I'm one of, because we're also sponsors, but our investor class, they get 100% of the distributable appreciation. So we got 2 deals in under the wire last year for 100% bonus depreciation.
Nice.
We did cost segregation studies on both of our acquisitions last year to maximize the the personal property allocation of the purchase price. And so About 60% of our purchase price on those two deals will be distributed back to, well, I'm sorry, distribute is the wrong word, will be allocated back to the partners as depreciation expense, which they will then be able to use based on how their own personal tax situation is. But they won't be generating any, they won't be receiving any taxable income from us because it'll all be sheltered. They're getting current cash at about a 10% cash on cash clip right now, and then they won't have any tax impact on that. So that's current.
So can I
Three
pause
to
you?
four.
Can I pause you
Yeah,
there? Just so I
sure. Yeah.
understand. Okay. So someone comes in, puts 100 grand into your office deal.
Yep.
They're going to get a 10% return. So cash on cash. So at the end of the year, they're going to have an extra $10,000 of cash coming in. And
Correct.
then you're going to shelter that with your depreciation and your bonus depreciation.
Correct.
Is there
Which,
any
to the
other,
extent they can't use, that rolls over to future years to use against additional income.
but they get 60% of the depreciation. So if they put 100 grand in, are they getting 6,000 back or are they getting the full 10,000 back?
No, they're getting. Glad you asked. So 60%. So let's just say it's a $10 million property.
Okay.
$6 million of that is coming back as depreciation in year one. So they don't get 60% of our investor class got 100% of the depreciation. So the sponsor with that hat on, I'm getting none of that. But I'm also investing with my investors. So I'll get my pro rata share of that $6
Sure.
million to use against my own taxes this year. So $6 million of that $10 million purchase price is rolling back out as depreciation in year one.
Yep. So that leads me to this. So you've bonused, you got your cost seg study, right? And then the rest of the 4 million, right, is distributed over, you did your cost study. So,
Yeah,
I mean,
31
not
and a
all of it.
half years. Yeah.
Yeah.
Right.
So one of the reasons why people have, kind of talked to me about liquidating is because they've kind of run out of the depreciation and now they're getting hit on the tax implications, like, from their distributions. So is that factored into your guys's, like kind of your long-term strategy? Like what happens when you run out of depreciation?
Um, I never make taxes my first decision maker.
Sure. That's
And frankly,
yeah.
I've never mind paying taxes on real income that I actually receive.
Mhm.
I'm old enough to remember the old phantom income thing where you used to get the taxable income but none of the cash. Um, so I think a good investment is a good investment, and if this thing continues to, if the investment continues to throw off good cash and is expected to, and you pay a little tax on that income, then I don't see that as a necessarily bad thing. Now, to the extent that you want to sell that, take your capital gain and roll that into another one, and as you and I know, there are many ways to shelter that gain. Um, I guess I'm a little cautious in that. I like the asset I know versus the asset I don't know.
Yeah,
If
that's
you want to
fair.
look at it that way, if I'm confident in our own management, as I said, we manage our own stuff. Completely understand if different investors have different point of view on that, and there may be more tax efficient ways to do it. But our number one is cash flow.
Yeah, that makes sense. I like because that means that you're not letting the tax tail wag the investment duck. That's what
Yeah,
happens with a lot of people.
I actually came out of college when all that was going on, so
Yeah.
I was just a youngster when they did the 1986 Tax Act when they did away with all that stuff. But yeah, I saw deals get done exclusively for tax purposes, and they ended up being bad deals. So
Yeah, they can definitely hurt you.
yeah,
Interesting. Okay, cool. Well, we are coming up on our time here. I know I want to, respect it. So I'm going to get you into just a really quick lightning round here, and then
okay,
we're gonna let you go. So um, Real quick, you said you were Alabama and Tennessee. So Alabama or Tennessee?
Well, yeah, I'm an Auburn grad, but between those two, I'm going to pick Alabama.
Nice, nice, cool. What is the best piece of advice that you've ever received?
Ah, interesting. Yeah, right before I got into real estate investing, I was commiserating with a mentor of mine, and he just said, "Stewart, you got to get into the game. You got to get," because all I was doing was whining about, you know, only making money in my CPA practice, but I wasn't building any wealth. And he said, "Well, you don't have anything in the game." And he referred me to Rich Dad, Poor Dad,
Mm,
which is one of the best, worst written books in the world. But the advice is sage, and it's 200 pages, so everybody ought to read it.
yeah, definitely. Cool. What is your favorite leadership quote?
Trust but verify.
Nice. All right. Well, is there any parting words that you got for us today?
Uh, Completely agree that real estate is the single best investment ever created in humankind. And it might seem daunting, but you got to get into this game because Wall Street is not shooting you straight. I like stocks, I own stocks, but Wall Street's not shooting you straight.
Awesome. Cool. And where can people find you?
Please find me at harvardgracecapital.com, also on LinkedIn, but at harvardgracecapital.com. You can find a link to book a call with me. I love to talk with anybody about anything related to real estate. Would love to hear from anybody who's interested.
Yeah, absolutely. And you guys can find us at capitalgainstaxsolutions.com. We actually didn't really get into what we do, but we have a strategy for deferring capital gains tax on any highly appreciated asset called a Deferred Sales Trust. Stewart's nodding his head.
It's an incredible vehicle.
Because he knows all about that. So what I'm going to do now is I'm just going to let that linger and say, if you guys want to learn more about that, come to capitalgainstaxsolutions.com and come to our mastermind group every Friday at 10 a.m. Pacific, 1 p.m. Eastern. It's an awesome strategy. Go check out harvardgracecapital.com if you want to get in touch with Stewart. Stewart, thank you so much for coming on. Really appreciate your time and the value that you have provided. So thank you. Thank you very much.
Thank you so much. It's an honor.
Yeah, absolutely. And thanks everybody for listening to another episode of the Capital Gains Tax Solutions podcast. Not having a clear plan is the enemy, using a proven tax deferral strategy, and buying into real estate that cash flows is the ultimate way to create, preserve, and grow your wealth. Please rate, review, subscribe, hit the like button, subscribe button, notification bell. It really helps us out so we can have more guests like Stewart on our podcast. So thank you guys so much. Thanks again, Stewart. It was an honor.